All right, guys, so we're going to talk about synthetic options. Synthetic meaning, anything synthetic is a replica, right? Or a replacement, a fake, if you will. And options are no different than anything else, meaning a call position can be constructed using puts. A put position can be constructed using calls. Okay, that's what's known as synthetic options. And the only way we can do that is if the premium levels of a call and a put on the same strike, same expiration, are the same. Otherwise, there would be massive arbitrage opportunities. Right? If calls were mispriced to puts or puts were mispriced to calls, there would be a massive arbitrage opportunity. So let me get a whiteboard going here. Okay, so I started last week, I put out there an algebraic equation for stock calls and puts. Does anybody remember what that equation was? No, Andrew, but that's a good answer. Tom, close but not correct. Martin, you got it. Okay, so stock equals call minus put. Okay, and we could look at that in a number of ways. We could look at it from a dollar standpoint. We could also look at it from a delta standpoint. Okay. The delta one is easy. Okay, so if you think about it first, looking at it from a delta standpoint, okay, the delta of stock is what? Anyone? Okay, perfect. 100. No. We're not asking what the definition of delta is. We're just saying what is the delta of stock. The delta of stock is 100, right? Or 1. Because if you own 100 shares of stock and the stock moves up $1, you make $100. If you own 200 shares of stock and the stock moves down $1, you lose $200. So it moves 1-to-1 with itself. Okay, so from a delta perspective, you have 100, which is your stock, equals call delta minus put delta. Okay, so let's look at, Shane, you said Tesla, so I have Tesla up on the board here. Let's look at any strike. Okay, and let's just keep it something near being at the money, but let's look at any strike here. Okay, so let's look at the 260s. Okay, you can see the 260 call is a 43 delta. The 260 put is a 57 delta. So if I throw that in my equation here, 100 equals plus 43 minus, now remember, put deltas are negative. Is that equation equivalent? Russell, that's correct, but that's why we're going through this exercise right now, to show you that a call can actually be a put and a put can actually be a call synthetically. Okay, so if you look at any strike, you're going to find the same relationship here. So let's look now at the, something way out of the money. The 270s. Okay? 270 call is a 16. 270 put is an 84. Okay, so if we do this example, then we have 100 equals 16 minus a minus 84. Oh, let me change that around. I didn't do my plus there. Okay. Come on, why are you not? There we go. Okay. This was the 270 strike. Okay, so from a delta perspective, this equation works. So a synthetic stock position would be the equivalent of owning the call and being short the put at the same strike. That would give you the same exact properties as being long the stock. And if you wanted to be short stock, okay, you would be short a call and long a put. And the deltas would all match up, equal up from this algebraic equation. Okay, so a synthetic stock position would be plus call minus put. Okay, so the same equation is true for a short stock position. So minus stock would equal a put minus a call. Okay, so if we did the exact same relationship here, using delta, same strikes, everything, okay, you would have minus 100 equals, and then if we just take the same 260 and 270 strikes, the put is a minus 57 delta, and the call is a minus 43 delta. Okay, and then the same for the 270 strike. Minus 84 delta on the put, minus 16 on the call. Okay, so there's the relationship from a delta standpoint. The synthetic relationship of calls, puts, and stock. Okay, now, Russell, tell me what you're lost. What part are you lost? There's no difference in these two equations other than one, the top one, we're trying to replicate a long stock position, and the bottom one, we're replicating a short stock position. Does everybody see the relationship here? Okay, so that's from a delta perspective. Now let's look at it from the premium perspective. And this is what we talk about, where the premium of calls and puts of the same strike, same expiration have to be the same. Otherwise, there would be an arbitrage opportunity. Okay, so let's look. Let's stay with Tesla here. And let's stay at the money. That's going to be the easiest. Okay. Let's stay with the 260 strike. Okay, now we're going to have to write a couple things down here because the market, the market's not going to stop for us, right? So we're going to have to write down, pick our point in time of stock price, call price, and put price. Okay, so right now with the stock trading, again, 258.50, I'm going to try and capture these prices. We've got 410 and 565, and that's with the stock 258.45. Okay, that's what we're going to use. Okay, so Tesla stock equals 258.45. Okay, the 260 call is $4.10. And I see I misspelled the. Okay, and the 260 put was $5.65. Okay. So, first off, let's look how much premium there is in each of these options. How much extrinsic value is in each of these options. Okay? So how much extrinsic value or premium is in this call? Okay, what makes up extrinsic value or premium? Okay, what makes up that number in the price of an option? No, that is not correct. Finally got the right answer, John. Okay, so an option, call or put option, okay, is made up of intrinsic and extrinsic value. Extrinsic value being the added premium, intrinsic value being the difference between the stock price and the strike price. Okay, so for instance, the 260 call, if we were at expiration, would that call be in exercise? Okay, so far we have a yes and a no. Okay, what does it mean? There you go, John A. Right? It would have, it's out of the money. So it would have no value at expiration, right? The 260 call is out of the money. right? So it's worthless at expiration. No, Shane, the 260 call is out of the money. Whether you're the buyer or the seller, the 260 call at expiration with the stock right here at 258.45 is worthless. Right? Does everybody understand that? Okay, so if it's worthless at expiration, that means there is no intrinsic value and that the entire price of that option right now is all premium. It's all premium. All extrinsic value. Okay, does everybody get that? Does everybody get that concept? Okay, so this call option then has zero intrinsic value. It's all extrinsic. Or premium. So there is $4.10 worth of premium. Everybody get that? So the entire amount of the price of that option is all premium. It's all extrinsic value. Okay, now let's evaluate the put. Okay, how much premium is in the price of this put? Okay, so if we were at expiration, what would the intrinsic value be of this put option? It's in the money, it's not out of the money like the call option is. So there would be some intrinsic value. Okay, Simon, Sharish, Mark, Pete, Shane, you guys have it right. Okay, how do we know that? Well, what does the 260 strike put allow you to do at expiration? If you own that put, what does it allow you to do at expiration? Okay, sell the stock at 260. Exactly. So if you are able to sell the stock at 260 and it's trading 258.45 in the open market, the difference is how much? Exactly, $1.55. That is the intrinsic value. Okay, so if there's $1.55 of intrinsic value, how much of the price of the option is extrinsic or the added on additional premium? Exactly. So $4.10 of extrinsic value or premium. Okay? Now, why is this important? Right, John? Exactly. 410 on the call side, 410 on the put side of premium. Why is that important? Well, right, there is no arbitrage opportunity. Exactly, Simon. If they were different, there would be. Not delta neutral, Dennis. No, they're definitely not delta neutral. As, as we identified above here, they're premium neutral. Excuse me. Extrinsic value, premium neutral. Okay? If the options, the call and the put options had different levels of premium, then one would be considered more expensive or less expensive than the other, and there would be an arbitrage opportunity. Okay, so let's take that a step further. Does everybody understand this right here? The amount of premium. Okay. Arbitrage opportunity LOEs is when one item you're comparing against another is more expensive, and it becomes advantageous to buy or sell one versus another. But here, the price of the options are exactly the same from a premium standpoint. There is no arbitrage. Okay? But let's say, for whatever reason, and I'm going to use the put values being a little bit more expensive here because in our conversation Friday, someone said puts are trading more expensively. I said, no, they're not. Okay? Let's say the put was trading 580 instead of 565. Okay? What kind of position would you then want to have? What do you mean by put, Pamela? Eloise, what do you mean? Okay, Dennis, you would want to sell the put, and how would you hedge yourself? Okay, Mark, good. Good. Mark said buy the call. Now, how would that be a hedge, and what might be missing to truly hedge that position off? Right, the call would be cheaper, Pamela. So if the put was 580, I would want to sell the put and buy the call, right? As my arbitrage opportunity. Because there's more premium in the put than there is in the call. However, if I do that, if I just have a position that is short a put and long a call, okay, what is that equivalent to? Synthetically, what is that equivalent to? Not how much arbitrage, Pamela. 15 cents is the arbitrage. Joseph, you got it. Frank, Eloise, good. Remember, if I look at my equation for a balanced equation, this right here equals this right here. So if I have bought the call and sold the put, that is the same exact position as owning the stock. From a delta standpoint, it is the exact same position. So now, if I truly wanted to hedge my position from a delta standpoint and lock in this 15-cent disparity that we're talking about, the arbitrage, what would I have to do with stock to completely hedge off this position? Okay, so Russell and Tom, what is my synthetic position right now? Being long a call and short a put is equivalent to what? Exactly, long stock, right? If I own the call and I've sold a put, that is the equivalent of owning the stock. So if I truly want to hedge off my position, I have to sell stock. Right? If I want to get back to a delta neutral or zero delta position, I have, being long the call and short the put, I have how many deltas? Okay, we figured it out up here, but if I have a long call and a short put at the same strike, I have how many deltas? Exactly, Tom. I have plus 100 delta, which is the equivalent of stock. So to hedge, I would have to sell stock. Does everybody understand that? Okay, now the question becomes, I know I have to sell stock to hedge my deltas. What price do I have to sell the stock to lock in this 15 cents of arbitrage? Well, Tom and Deborah, that would work, but I'd be locking in a lot more. If I sold it up at 260. So 258.45 would be my area that I would be able to make that 15 cents. Simon, you got it. To break even would be 15 cents lower than that, or 258.30. That would be my break even. Anything 258.30 or higher, I will make money. 258.45 is that level that I'll make that 15 cents. Okay, and let's see why. Okay, let me get to another whiteboard here. Okay, let's see why. Okay, so as a review, Tesla 258.45. The 260 call was 410, and the 260 put originally was 565, but we're now said what happens if it's trading 580. Okay, so on the put side, well, actually, let me put this up here. This is all premium or extrinsic value on the call side. And here, there's $4.35, excuse me, $4.35 of premium or extrinsic value. So let's put this all into the mathematical equation, okay? Remember, stock equals call minus put, okay? So we have 258.45 on that side of the ledger, right? What 05 are you asking about, Pamela? Yes, it is Simon, thank you. It is 425. That is correct. Thank you. Okay. Okay, so going back to this equation, $258.45 equals, and remember, we're basing this, we're comparing this to the 260 strike, right? To the 260 strike. So we have 410 minus 425 of the premium. Okay, if we base this off of the 260 strike, this should be $1.55, right? 260 minus 258.45. which is $1.55 here. Right? Intrinsic value would be $1.55, right? From the 260 strike. However, if we go back, we found that $1.70. Okay, let me put this back up here. Right, with the 260 put trading 580 and the stock at 258.45. It was $4.25 of premium versus $4.10 of premium with the stock 258.45. So this extra 15 cents here would put us at a break even of 258.30. So anything over 258.30 you would be locking in money. Anything over 258.45 you would make more than the 15 cents. So let's say you were able to sell stock at 265. You know, let's say you had this long call and short put position and you were able to sell stock at 265 instead. You know, massive winner, or 262 or 260, whatever it was. Okay, so this shows you both from the delta and from the premium standpoint how options relate to one another. And they have to be equivalent. Otherwise, there is an arbitrage opportunity. Now, there are times, and this is going to be a conversation for another time. There are going to be times when they're not equivalent. Okay, what are the times that they might not be equivalent even though the market is in line? When will the premium levels be out of whack? Okay, good, Simon. One is when there is a dividend. Nope, not earnings. Not earnings, guys. Even with earnings, and Tesla has earnings next week, and we could look at any one. Even with earnings, calls and puts still have to have the same amount of premium. They both may be really expensive, but they both have to have the same amount of premium. Nope, not a news event. Nope, not VIX. Doesn't have anything to do with volatility. Got to think outside the box a little bit. We talked about this last week. So dividend is definitely one of them. Nope. Okay, remember when a stock, especially a new stock, comes out. Okay. an IPO, a Beyond, any, Slack, whatever it is. These stocks come out and there's not a lot of stock to trade, right? There's not a lot of float. Okay, so you cannot short the stock. You cannot borrow the stock. Hard to borrow. There you go, Frank. Okay, so what happens is, if people want to sell the stock, but you can't because it's hard to borrow or you're not allowed to short the stock, what would people do? What's another way of getting short a position if you can't sell stock? No, not buying a call, not selling. Well, you can, Patrick. You could buy puts. So at that point, puts can become more expensive because people are willing to pay an extra premium because you can't sell the stock. Okay, exactly. Okay, but those are the aberrations. These two instances of a dividend and of an IPO where there's not a lot of float, those are the outliers. Those are the aberrations. Other than that, puts and calls should always be priced equivalently. Otherwise, there'd be an arbitrage opportunity. Okay. Does that help everybody? All right. I'll bring it back to you. Cool. All right, let me get this posted up here. Not an easy concept to understand. However, you should be able to understand that the premium levels in calls and puts need to be equivalent. Otherwise, there is arbitrage opportunity. Cool. All right, guys, let me get this all posted up here, and I'll be right back.